Right now, talking to Unmesh Sharma, Head of Institutional Equities at HDFC Securities. And Unmesh, thanks for being patient with us, because I know we had to move the timing of this interview a bit. And while we were talking to Kalyan, you were waiting by. So thank you so much for being patient with us today. But Unmesh,
Thanks, Neil.
how are you guys as a house wrapping your head around all that's happening around the world, particularly with regards to tariffs? And does that sour the case for investing in India currently, despite the fact that the markets have come off from those slightly heady levels?
No, I think, of course, I think there are two big factors. If you leave out even what has been happening on the geopolitics. If you see, there are two very big things which have happened. One is the Indian currency as compared to globally, whatever you compare with the exception of the US dollar, has actually not done that well. Okay, because the US dollar has actually weakened quite significantly, and yet we have actually weakened further against the dollar. Now, what happens is that investors as well as common people are used to looking at the Indian currency just in comparison with the USD, and so it doesn't look like it is that bad. But relative to other currencies, I think it's been a bit of an issue. I think that the currency market is reflecting what the uncertainty on the geopolitics a lot more than what's happening in the equity markets, which brings us to basically what do investors do and what we are thinking. I think the stock market effectively is telling us that this a period of severe uncertainty, and definitely the 50% tariff which has been imposed on India is not something which is going to last. Do we as a house think that that is the case? Answer is probably yes. There are now multiple visits to India in August. So by the end of August, the picture should become clearer. We genuinely believe that this current scenario is not going to last. But at the same point in time, I think somewhere there seems to be a consolidation phase which has happened, but it has not led to a correction. So, in essence, what's happened is that all the negativity and the uncertainty around the global geopolitics for India has been absorbed by the influx of liquidity, mostly domestic. And that has kind of kept the market where it is. And as a result of this, given that there is no correction, even if things start to stabilize, there is likely to be no major upside or no major downside in the markets, maybe in the next couple of months, in our view.
Okay, Unmesh, so keeping those things in mind, and I like how you started off saying that even if you keep geopolitics aside, there are other factors. Does this keep you on the sidelines and have, and the other thing is, one is earnings, but other thing is the commentary that has come in, because you guys would have analyzed that so well, right? Is there, forget the export-oriented sectors, but is there some light at the end of the tunnel for what could happen in the next 3 quarters, or is it wait and watch right now?
Yeah, so, if you look at bottom up, we cover over 250 stocks here at HDFC. Now, obviously, not everyone has reported yet, so we are waiting for maybe another week to look at the data, on a completely aggregate basis. But so far, what we are seeing is the following. One is that we had this estimate that the full year earnings growth for the market will be in the region of 11 to 12%. I think, it was starting with a low base in any case from the first quarter, where we were expecting around 8%. We feel that 8 or 9% for the first quarter, which, while it has not ended, it is looking like we are on track to miss that by 1%, maybe 1.5%. Is that very concerning? Answer is no. As far as, so we don't need to see probably aggregate earnings or FY26 coming down. However, I think we will have to keep what we are noticing is that if you look at the consumption side and the investment side, okay, so on the consumption side, the top end of the consumption is kind of stable. So that was like, that K-shaped recovery has kind of cooled off, but it's not doing badly because the base has started to come in. The urban poor, which was the weak spot for the last year, urban poor and middle class has started to kind of stabilize. And at the rural level, given the fact that the spatial and temporal distribution of monsoon again seems to be okay, with the exception of Bombay, I think it's raining everywhere. I think it's generally looking like that on a reasonable base will also continue to perform. So on the consumption side, things will start to look better. from where we are, because the next 3 quarters also the base is okay. As far as the investment side is concerned, I think April and May was very good, and that has led to a fairly strong quarter. On that, I think that there is a very ambitious target of the government to spend money, and also whatever is happening on the the second order benefits of all of that. So it feels like we've started the year on track, where it was expected to be seasonally slightly weak, and I think things, that 11-12% earnings growth will get delivered this year.
Unmesh, just on that Bombay Rains comment, I think the collective spirit of Mumbai has sent up a prayer to spare us this time. But having said that, is this the period for a brave heart, or would that be foolhardy? Because markets are giving opportunities, markets are giving dips, but there's no clarity if people with cash on the sidelines should come in and where.
No, so look, okay. So there are two things. One is that do we expect a big correction, as a result of which, if you have cash, should you wait it out? The answer is we are not seeing that. In fact, if you look at our model portfolio, we have only 1.3% cash in there. We usually keep it between 3 and 5. So that's a sign that we continue to remain bullish on the market. The second is that if there is some confusion, if you see our model portfolio again, what you will find is that there is a fair number of large sectors where we are very close to the index. Now, while in periods of time when there is a lot of uncertainty, that's not a bad strategy to have. Okay. So if you are sitting on the sidelines, then I think that on a staggered basis, period of consolidations are actually when you actually buy. So from that perspective, no point sitting on the sidelines. Having said that, when you're picking sectors or stocks, the one single big differentiator which has started to come in is the fact that, given that stocks, even though there has been a period of consolidation, are not really cheap, okay, still a standard deviation above the long-term mean, you would want to ensure that you are buying stocks which have very good clarity on where the earnings are. So to exemplify, so if you look at our portfolio on IT, for example, so while we are very close to the index, okay, I'm talking about the model portfolio and what we have in IT. So I'm just exemplifying. So while we are underweight on both TCS and Infosys by a small amount, we do have an out of market bet, which is Info Edge in there. Okay. Which is a positive 1.5%. So basically what happens is, on a sectoral allocation, you are very close to benchmark, but you take bets on companies where you are clear on earnings.
So earnings is what you have to keep in mind. And of course, like you said, Unmesh, that story is not yet played out, at least for this quarter. Hopefully, we'll have a chance to talk in more detail when the earnings picture becomes clearer. But in the middle of result season, we'll have to wrap it for now. Thank you so much for coming in, Unmesh, and we always enjoy
Thank you. Thank you, Tamanna. Thank you, Neeraj. Thanks.
Yeah.